Welcome to Money Monkey, a series of videos about money and its uses. Today we're going to be talking about commercial bank money. Quick caveat here, I've worked in financial services for over 25 years in senior management functions across the industry. These videos are designed to give you information and not advice. I want these videos to make you curious about money and give you some ideas on how best you can make it work for you. Everyone is different. What works for me will not work for anyone else. This is not advice. It is simply a collection of thoughts that might help you stay better informed about money, its uses, and the financial ecosystem. So let's look at commercial bank money. What is it? Why do we need it? And how is it managed? What is it? Commercial bank money is generated by a practice called fractional reserve banking. Banks take deposits from customers. The bank then uses that money to lend to other customers, knowing that the depositor does not need it back all at once. This process of depositors and borrowers is cyclical and mostly predictable. This mechanism enables depositors to earn interest on their unused money and borrowers to borrow money that gives them greater financial flexibility. Some facts. All the money in the world, about 97% of money that we think of that is in circulation is commercial bank money. Fractional reserve banking and commercial bank money are relatively new, only being a few hundred years old. Command and control. The process is tightly controlled by central banks and regulators. There are international agreements in place that establish liquidity and capital requirements that financial institutions must adhere to. Faith, trust, and no pixie dust. Commercial bank money is made possible only because of the faith of the wider community in the underlying system. There are numerous laws and government agencies in most developed countries that underpin the faith and trust of the system. For example, in the UK, there is the Financial Services Compensation Scheme, and in the US, the Federal Deposit Insurance Corporation. So let's look at this whole process. Imagine Jeff, the money monkey, deposits his salary into his bank account because he doesn't need it all right now, and the bank is safer than the money just sitting on his sofa. The bank also pays him a little bit of interest. Number two, the bank retains some of Jeff's money to maintain liquidity. This means that as Jeff needs his money, the bank will have it available to him through his small retention and ongoing repayments from borrowers. Number three, the bank lends Sophie some of that money so she can start a business. The bank also makes loans to Carlos to buy a house, Marie to finance a new car, Jeff to pay down his credit card, and some money to the government. Number four, the borrowers all make their regular scheduled payments to the bank to cover the principal and interest on the loans they've taken out. This means that Jeff can use his money anytime he needs. That's an awful lot in one slide. Let's unpack it a little bit. Jeff deposits his money into the bank for a number of reasons. Firstly, it's more secure than being under his mattress. Many countries have depositor compensation schemes if banks go broke. Mattresses don't. Secondly, in most countries, bank accounts are a necessity. Many aspects of modern living revolve around having a bank account. This includes salaries, state benefits, mortgages, loans, and other credit facilities, utility companies, etc. And finally, the bank pays interest. Even if it's a little tiny bit, it's better than nothing. This puts your money to work. We'll cover in later video how to sweat assets and the different returns you can expect from different risk profiles. Liquidity, not liquid tea. Banks retain some of Jeff's deposits in order to be able to meet the day-to-day demand of retail customers. This is not a fixed number and can vary significantly depending on circumstances. Banks are required to monitor these reserve levels and maintain certain assets they hold in a more liquid or available form. These reserve requirements are set by governments. A good example of this is your own household. Some of your money will be immediately available to pay living expenses and monthly bills. Some will be in savings for a holiday or a new sofa. Some of your money will be in your home. Some in your pension. Your current account is used for money you need today. The equity in your home is more difficult to access, and it would not be feasible to use it as a daily resource. For banks, they will have their assets allocated to hundreds or even thousands of investments, all with different risk profiles. These range from government bonds that are very, very liquid to retail or commercial mortgages, which are very illiquid. The bank will make loans to individual corporations and governments that match their internal risk profile. This profile is influenced by several elements. These include, but are not limited to, the creditworthiness of the borrower, collateral and security, capital and financial strength of the borrower, purpose of the loan, industry and risk and sector risk, macroeconomic and market conditions, borrower behavior and relationship factors, loan structure and terms, and regulatory and compliance considerations and internal risk models and ratings. So let's square this circle. Lenders can take out loans from banks to use for any number of things. This increases the circulation of money within the economy and enables market participants to realize their ambitions. Having access to credit provides financial flexibility. We don't have to save for every scenario. It provides a safety net. We can use credit for unexpected expenses rather than keeping assets back. And cash flow management. In a system where expenses can only be equal to or less than income, there would be stagnation and low growth. With the benefit of flexible financing, people can have more control over their money and their lives. They can benefit from opportunities now rather than waiting for months or years into the future when they have saved enough. So, it's all that easy. No, it's not. Commercial bank money and fractional reserve banking are a highly sensitive mechanism. They rely heavily on things staying normal and being predictable. Unfortunately, disruptions are common and can be devastating to market participants. For example, even insignificant rumours can start a snowball effect of depositors withdrawing their cash, causing bank runs. These runs are less regular now, but there are better controls, but they still happen. Economic downturns can affect both depositors and lenders, and when loan repayments are not met, this can have disastrous consequences. Fractional reserve banking can introduce inflationary pressures as banks lend more money without the necessary controls. Equally, a lack of liquidity, thereby reducing the amount that banks can lend, can cause an economy to shrink, sometimes violently. Central banks around the world have put in control mechanisms, including things like liquidity requirements, stress testing, counter-cyclical capital buffers, and deposit protection schemes. These measures are complicated and expensive, but tend to be effective, right up until the point where they're not. So now you know a little bit more about commercial bank money. Knowing what fractional reserve banking is can be helpful, but knowing what to do with credit when you have it is invaluable. We'll look at that next time.